Hey everybody, welcome back to Chipstock Investor. Happy Friday. Nick's got his flamingo shirt on.
This is probably the last Flamingo Friday of 2024. It's getting too cold. Maybe there'll be Flamingo Friday merch in 2025. Maybe. Ask Casey about it in the comments.
We'll work on it. Actually, most of you will probably be watching this over the weekend, so I hope you had a great Friday and I hope you have lots of good weekend plans. But we're going to talk to you today about Netflix. But to tee that up, I want you to think back to a video we made on AppLovin just last week, where we talked about the best use of AI so far, ads.
Yeah, it seems Netflix has caught the data center computing bug. Are they buying a bunch of NVIDIA GPUs? Well, maybe Netflix isn't exactly, but we'll talk about this. Talk about what's going on and why we think Netflix is still a great buy. One of our top picks of 2024. You probably remember we finally swapped some old, grossly underperforming media stocks last year and finally swapped it out for Netflix. We still like it.
Let's focus on where Netflix is in this hierarchy of the economy chart. Netflix has a global audience of over 600 million people. It has a ton of power in one of the most lucrative spots in the economy, ads. Global marketing is a massive industry hurtling towards $1 trillion a year in spending.
Now, digital marketing in particular is very powerful. There's a really good reason why it is gobbling up now the majority of global marketing spend. And Netflix making a move into digital ads in particular makes a lot of sense because it has the power to fine-tune marketing campaigns based on audience demographics, audience interests. And this is becoming the driving force of that multi-trillion-dollar per year products and services sales top of the funnel in the global economy. If you have a product or a service, you can find your ideal match in a customer using digital ads, audience metrics, retention metrics, indications of interest. You can measure all those things unlike you ever could before.
Let's take a look at our global IT and networking infrastructure, our cybersecurity industry flowchart to illustrate where Netflix is fitting into this. Netflix offers streaming services in a bunch of countries. And one of the things that Netflix does is it operates close to the end user. That data is located close to the end user. And so they tap into local internet service providers. With that being the case, this puts Netflix in a very powerful position when it comes to ads.
Yeah, operating this type of service obviously is very complex, but Netflix has now been at it for a long time. And so it makes total sense that they announced that they are going to be building their own ad server, their own in-house advertising technology platform. But Casey, that begs the question then, what exactly is an ad server? Before we continue, let's talk about that. Let's define what an ad server is.
Let's have a quick shout out to our sponsor of this portion of today's video, Moomoo.
Moomoo is still running that special offer for new users that have not opened a Moomoo account yet. If you get that open here before the end of the year, you get up to 15 free stocks, and Moomoo is kicking in some cash when you fund your account as well. Could be a nice booster if you're getting started with your investments.
You can open a new Moomoo account, link below in the description with our unique code.
Okay, about that ad server. So we're pulling this definition from Amazon AWS because Netflix actually operates the majority of its operation in the AWS, Amazon Web Services cloud. So we thought it appropriate to get a definition on what an ad server is from none other than AWS.
AWS describes it as a technology engine that enables advertisers and publishers to optimize, manage, and deliver ads across a variety of paid channels. So in a nutshell, an ad server is a collection of servers installed in a data center. In Netflix's case, it will probably be categorized as a supply-side platform. And Nick, maybe you can tell us the difference between a supply-side and a demand-side platform.
Okay, so a supply-side platform, or an SSP, is an ad server that helps a publisher manage its ad slots that are available for sale. A lot of companies have their own in-house SSPs. Think companies like Disney, for example, as they manage Disney Plus, Hulu, and a lot of other properties, they have SSP software that manages those ad slots that a marketer could purchase and then display their marketing campaign in that ad slot. Besides in-house SSPs, there are a lot of third-party SSP software companies. Think like Magnite, for example. Then on the other end of the spectrum is a demand-side platform, or a DSP. Pretty much everyone in big tech has a DSP these days. Google has one, Meta, Facebook, of course, Amazon AWS has a DSP. The Trade Desk is a DSP. This is a software platform that helps the marketers manage the purchasing of those ad slots from a publisher. Now, whether it's an SSP or a DSP, what exactly do these ad servers do?
They use AI. They run complex algorithms that match the supply side with the demand side. Marketers can set their budgets, find the right audience, and then measure that data on the effectiveness of their ads. That's why Netflix said it's going to keep its ad server open to various demand side platforms, or DSPs, like the Trade Desk or Google, so it can really maximize the selling of ads.
Okay, good stuff. This is really interesting. You probably know by now, if you're a Netflix subscriber, that you have an ad-supported membership tier available to you. We're actually almost 2 years into Netflix offering this ad-supported tier, and they're still generating a lot of growth from this 2 years in. In Q3 2024, they said 50% of membership signups were the ad-supported tier. And up to this point, Netflix has actually been using Microsoft's ad server. However, Netflix had announced that it was going to be building its own proprietary ad server technology. They're going to start rolling the first results of that out in Canada in November, and then they'll progressively launch it to all the other countries that have an ad-supported tier next year in 2025. This is really important, Casey. They mentioned in the shareholder letter that they're reaching something of a critical mass, a number of subscribers where it really starts to make sense to bring that technology in-house. And I think we should translate that as Netflix ad-supported tier is starting to become really profitable, which bodes really well for Netflix's operating margin and free cash flow profit margin, which you've seen here on this slide steadily increasing, especially the last few years on a free cash flow basis in particular. This can be really, really great news for Netflix long term if this ad-supported tier continues to scale up.
So up until this point, Netflix has been using Microsoft as its ad server. And I would say that Microsoft is probably not known for being the most cutting edge ad server platform out there. So it makes a lot of sense that Netflix is thinking about making their own proprietary ad server.
Yeah, it does. And maybe you're wondering, where did Microsoft's ad server come from? Microsoft is the company, of course, behind the Bing search engine. So it has been in ads for a long time, but yet definitely nothing that matches really what Google is capable of doing, or Meta or Amazon. But maybe just a brief recap here on where this ad server tech came from. So back in 2018, AT&T, that AT&T, the US telecom company, acquired the small software business called AppNexus, which operated a small little ad server. They acquired that for probably about $1.6 billion. Didn't work out so well. Of course, AT&T kind of blew up its business, spun off Time Warner, which is a whole different saga. They ended up spinning off AppNexus, which has been since renamed to Xandr, sold that to Microsoft for $1 billion. That deal closed in 2022. And then shortly after Microsoft made that acquisition, that's when they announced the partnership with Netflix, powering at Netflix's, which was at the time going to be the new ad-supported tier, delivering ads to people who subscribe to Netflix with ad support. So For the last 2 years, if you've been subscribed to Netflix and you've been looking at ads, Microsoft's ad server has been delivering those ads to you. And yet, Microsoft, not well known for this, but they do have some companies that they power ads for. LinkedIn, which they acquired, it's an in-house Microsoft company, but they do some external work for other companies as well. But Netflix obviously thinks it can do a lot better, and we agree ultimately.
If you've been following Nick's writing for a while, you may know that Nick had a pretty strong aversion to Netflix for quite some time. But Netflix has definitely turned the corner. They have a bunch of new features, including some live events like some live football, American football games coming up this year. So the addition of live events, this new ad server platform, definitely pointing Netflix in the right direction. And I know that we actually finally nibbled on Netflix this year. So maybe we can just break down some of the reasons why we decided to do that.
Yeah, all of those things, the ad-supported tier, live events, Netflix just growing up as a business overall. They turned the corner from negative free cash flow a few years ago to positive free cash flow. We showed you that chart earlier where you could see free cash flow margin turning positive, especially within the last couple of years. And now Netflix actually highly, highly profitable on a free cash flow basis. And we see a lot of upside for that to continue. And if you think about the power of a global ads platform, some of the best out there, Google, Meta with its Facebook and Instagram supply side and demand side platform, or even Amazon with its ability to display ads from marketers to the right consumer at the right time. We think Netflix actually has incredible power to do something very similar and not just crowd into an already busy digital ad space, but do something really unique. Netflix has said, especially this year back in May, that with their own in-house content and with live events, what they're actually going to offer marketers is the ability to tell a story that integrates with the content that viewers are watching. So there's probably going to be a lot of features in this ad server Netflix is building, like the ability to measure who the audience is and custom curate content specific for that audience. Think something maybe similar to like what TikTok has been doing with influencer marketing. That's quickly turned into a very powerful ad platform. We probably can't call Netflix influencer marketing.
Maybe not yet.
Maybe not yet, but definitely we see the potential of that happening and propelling those profit margins higher. That can be a really powerful combination. Netflix growing at a mid to high teens % revenue growth rate, plus profit margin rise increases in the coming years. That can do wonders for a stock.
Those ads sound kind of scary.
Digital ads are kind of scary.
Netflix has had quite the 2024. The valuation has been a little bit stretched, but let's focus on the forward-looking valuation. This chart from our friends at FinChat, you can get 15% off your membership with them. Link below in the description. On a forward-looking price to earnings basis, you can see Netflix at 33 times, and on a forward price to free cash flow, around 39x. A little bit more reasonable on a forward-looking basis. If you don't own Netflix already, we of course would recommend a dollar cost average plan for this stock or gradual buying in batches. Don't go all in at once on this one. And the reason for that is we do expect some volatility with Netflix stock at some point and fully expect no less than 20% drawdown when that happens. But if the progress remains unchanged, we would be a buyer again.
Yeah, absolutely. That's a given whenever there's a high premium on a consistently high growth stock. But even at this particular point, it's been quite the run this year. The stock is up well over 60%. Let's do a reverse discounted cash flow to see what kind of growth is baked in to the stock price at this point. What gets us to a fair value of, as of this recording, $755 per share, or a market cap of about $323 billion. So on a trailing 12-month basis, earnings per share at $17.65, free cash flow per share at $16.16. So if we blend those two profit metrics together and imply 20% per share profit growth for 5 years, and then just shy of 6% terminal growth rate, we have 5.75% plugged into this model, discount rate of 10%. That gets us to about $760 as a fair value, which is where the stock is trading right now. Definitely a fairly high bar, but not an insurmountable one if Netflix does continue to grow its revenue at a mid-teens percentage and gets some operating margin increase, thanks in large part to that ad server coming online and starting to kick in some serious advertising revenue for the company.
So I think maybe we need to start calling it, instead of the Magnificent Seven, the Magnificent Eight, although that's not as catchy.
Okay, we'll think long and hard on that one.
Yeah, we'll come up with something a little better.
Yeah, remember Netflix used to be part of the FANG stock basket. Kind of got dropped. Maybe I think we need to re-add it. Now that Netflix has its own ad server, I think it's finally time to call Netflix some sort of like media technology giant. It's time.
I feel like Netflix has really won you over.
They have. It's about time.
It's about time. Thanks everybody for watching this episode of Chip Stock Investor. Make sure you sub to the channel and check out our Semiconductor Insider membership. You can get that via a link below at Ko-fi. That gets you live Q&A events, all of our show notes, and access to our Discord channel to interact with us if you want. See everyone again at Chip Stock Investor.